with this potential divergence, right, in AI even, it does tie in nicely with our next theme.
It does.
And which is reflecting a broader kind of K-shaped dynamic that we're seeing in markets, right? We see kind of large companies versus small companies, higher income earners versus lower income earners. We talk about tariff sensitive sectors versus non-tariff sensitive sectors. Really a bit of a divergence between these areas. These dynamics were quite prominent in 2025. Do we see this persisting into 2026? And how do we change the way we think about growth, earnings, market leadership, et cetera? Chad?
You've hit the main points is that we've been seeing for a while, this sort of divergence, but a lot of what has been playing out with even with some of our other themes that have been compounding this sort of K-shaped economy, which of course then leads to elements of the market that that reflect that K-shape as well. So you've mentioned the mega caps have been the real beneficiary of the AI side of the trade. At the same time, Main Street, smaller companies have felt more pain. The labor market in general, consumers have felt more pressure. This is just really building upon what we've been talking about for years in terms of the gap between income disparity, or between those cohorts of the haves and the have-nots have just continued to sort of expand. And then if you get into policy, even just U.S. policy with a newish administration, more than a year in now, but you've got beneficiaries of some of the deregulation that's going to be a bigger factor this year. It was mostly just kind of passed into law last year, versus tariff sensitive sectors of the economy that have been on that lower K. Not by mistake, even in this graphic, we show the upper side of the K as kind of a bigger piece, because where does it all net out? In our base case, it's because it's sort of larger segments of the economy, certainly larger segments of the market that are reflected in the market are on that more beneficial part of the K. You probably see generally this being still positive for the broader economy, the broader market. But at the same time, it does mean that you will see some negative economic data prints along the way, which again can create some bearish narratives. It can cause, certainly you got to expect bouts of volatility throughout the year, and I think a lot of that will be that questioning, yes, we've got this sort of K shape, but is that upper side of the K still kind of winning the day? And we're also we'll be continuously kind of monitoring, are things evolving to the degree that do we need to be concerned that the lower side might be now weighing more heavily. The biggest thing would be obviously if some of the job loss, even going back to the prior theme, some of the lack of growth in the labor market, if that tips more into job losses, whether it's from AI replacement or other cooling elements of this sort of K-shaped dynamic, does that begin to swamp factors a little bit more towards more of a negative outcome? I think that's really like the way to kind of think of the economy as we work through this year, and also from a market perspective, looking at where there's some relative winners, some relative losers. I mean, the next couple of charts kind of get through the heart of the matter, looking at consumer confidence on this chart versus the market. Just going back even the last couple of years, you've had the market moving higher pretty much continuously, consumer confidence pretty steady, and then into last year actually heading lower. And if you dive even further one layer down in the next chart, you begin to see that it's more than just about consumer confidence overall. If you split consumer confidence sort of into income brackets, lower income, kind of medium income, and higher income, going back several years, the higher income cohort has been more confident, generally speaking. But really last year, this took on more of a K where, the lower income segments were exhibiting much lower sort of sentiment. And this to me is really picking up the fact of you've got markets, specifically, equity markets, but assets in general, prices are higher. The asset owners are really benefiting from that. So the higher income cohorts, they're the ones who own the assets. Values have been going higher. That wealth effect, I think, is becoming, and that element of that sort of reflexivity that even Soros talks about, where the market begins to drive the economy. I think that post-COVID, I believe that this is an even stronger relationship, right? As you have more and more participants in the equity market. In the US, Canada's pretty close behind actually in terms of just kind of individuals that have, money in the markets, right? And it's having a bigger and bigger wealth effect. Just if you've got markets at all-time highs like we do right now, even if there's some concerns in that lower part of the K, it is driving more and more economic behavior. It's why we're defying expectations in a lot of areas versus some historical relationships, and a lot of that is coming through, in things like the services sector, where you're seeing, in particular, a lot of spending has been persistent since. A lot of people said, initially this is just kind of a post-COVID factor. Well, here we are, kind of almost 5 years out, and that's still very persistent. I think the market has a lot to do with that, right? So the K-shape is kind of feeds back on itself as well. But a very interesting dynamic. But like I said, you're going to hear more and more about the Ks. You're going to probably see the bouts of uncertainty kind of driven by some of the negative elements coming out of that K as well.
No, I think Chad kind of covered the key points. Like the K-shape, it's not a new concept because it came up during the pandemic, but we were looking at K-shape in terms of which countries had access and were able to vaccinate versus those who were more behind the curve, and countries that were more exposed to global trade being more behind the eight ball versus countries like us that were more self-resilient. But one thing that we're very much looking for as well is just kind of that turnover point, right? So you talked about rates, and Chad talked about the impact on different asset classes. So small, medium companies, small cap companies have really lagged performance. And a lot of that's reflecting a combination of they don't have the scale, they can't retool their supply chain as easily, they don't have the same pricing power to deal with, let's say, the impact of tariffs, if it does hurt them. But one of the key things too is their cost of lending or borrowing is very high. So small, medium companies in the US, they might borrow from 6 to 8%, right? That's the cost of borrow from the banks. Whereas if you're a large company, especially if you're in the tech sector, your stock's an all-time high, you're able to access the bond market, corporate credit spreads are all-time tights. So it is that sort of divergence. But like Chad said, as the Fed cuts, one of the beneficiaries will be the smaller companies. So we are also very watchful of the bottom Ks. Even a little bit of improvement could help that rotation. And one of our themes last year, we didn't highlight it again this year, is just kind of the broadening out trade. And we are reflecting that in, different ways, diversification basically, in terms of sectors and geographies.